About how the business into the new year is going to go forward. And we have with us Ameera Shah, promoter and executive chairperson at Metropolis Healthcare, joining in on the show right now. Ameera, hi, morning. Great to have you on the
Morning.
show. Ameera, as we look into the year ahead, tell me what kind of trends do you foresee? Because just taking a leaf out of Q2, it turned out to be a little bit muted, seasonality into effect. What next in store for you?
Since COVID, to be honest, healthcare has played truant. There have been no trends that have actually stuck to what we saw as the typical trends playing out. So every quarter is a surprise for all of us. But I think if we look at it more from an annual basis and not from a quarterly basis, I think we are fairly on trend on the kind of indications that we had given. Market is growing around 8 to 10%, with the organized players growing faster, the unorganized players growing slower. That's certainly one trend that's emerged via COVID. Second one that's emerged is that people are looking to do more packages and more tests at least once a year because they do want to know and make sure that their health is in good shape. So that's certainly another trend. So we are seeing more bundling and more packages sort of being picked up. And third, we are at Metropolis specifically seeing a higher revenue per patient because we are able to move people up the value chain. So that's certainly a third one as well, where more complicated, more complex tests are being used. So broadly, I think we had indicated sort of a 12 to 13% organic growth rate, which is where we are on trend on for the first 6 months of the year. We had also indicated an expansion of margin from last year, which we are also on trend for the organic business. Of course, that's being slightly diluted because of the acquisition we did, which was a loss-making acquisition, which we are turning around quarter by quarter, and that's also absolutely on track. We're really setting ourselves up for a good finish this year and a really good year next year. So very excited.
Right. Ameera, hi, this is Harsh here. Talk to us about how pricing and competition is shaping up. Give us a pulse of that.
Competition, honestly, I would say has been stable from the perspective that all the new entrants that had to enter the industry had announced their entry by 2022. We haven't seen any new entrants post that. So whoever was expected has sort of come in. Has it changed the nature or the structure of the industry drastically? We've seen the organized number of players really expand. And we have seen, like I mentioned, the unorganized players grow slower. So overall, I think the industry is moving towards a consolidation phase, an organization phase, or a formalization phase, if you may. But that movement is not super fast. So you have to be patient to sort of see the trend over 5 years or over 10 years rather than sort of year to year. So I think from a pricing perspective, it's been fairly stable. We haven't seen any radical changes this year. Those who are in the market compete, but competition has always been intense. So no issues there, but it's not irrational, it's very rational.
Right. But Ameera, with, about almost 300 collection centers that you plan in the second half of the fiscal, tell me what kind of incremental throughput uplift do you anticipate?
So, what's important to understand is that collection centers is only creating the brick and mortar distribution. That the collection center doesn't automatically mean a sample gets collected, right? Because we're not in a commoditized business of product where you are just pushing out the product the minute you create a distribution. In our case, you create the distribution, which is only a center where the sample gets collected. But after that, you have to actually go and generate the demand in that segment, in that community, which obviously happens, but it takes its own time to play out. So normally we see about a 4-year a timeline for a center to get to a state of maturity where we feel like it's more steady state. Therefore, the first year center starts will be maybe only 20% of the mature revenue that you would expect at the end of 4 years. So you start to see it kick in, but it'll obviously kick in for a few months that year and only partially. But the next year, it'll obviously bring in more impact.
Ameera, the core diagnostics, it's reported high single-digit kind of EBITDA margin. How quickly can you ramp up on that? How quickly can you capitalize? Because that will be one of the places where you'll get the EBITDA margin lift from, I'd assume.
No, that's right. In fact, when we bought it in Q4, it was a loss-making entity. And we said that starting Q1, we would start to move it around. And we did. So from Q1 to Q2, we've already seen a significant move up. And we'll continue to see that play out in Q3 and Q4 as well. The idea is over the whole year, and again, I don't want to go quarter by quarter, but over the whole year of 25-26, core should have sort of a single digit margin, which would be significantly, obviously, at least 6-7 percentage points higher, or maybe even more than it was the year before, 600 basis points higher. So I think it's going in the right track. We had always mentioned that it will be single digit the first year, double digit the second year, and hopefully moving closer to our corporate margin by the third year. So we're staying on track for that.
Give me a sense. You're already at high single digit, right here. So single digit, are you underplaying this? Is there a likely outperformance to come from the core? And how much of that contributes to your overall EBITDA? And therefore, how much will your overall EBITDA receive in terms of a lift if that were to surprise on the upside?
Not really. I'm being very realistic. While Q2 was a single digit, high single digit EBITDA, Q3 is usually not the best quarter for our industry. So, you're going to see it only at best sustain or come down a little bit. And then Q4 again is a little bit better quarter. But if you look at the average of the year, you're going to get an average of a single digit anyway. From a run rate basis, it should be a high single digit by Q4. And that's what we'll use as a base to then go into the next year. It's a small percentage of our overall business. So I really don't seeing it impacting Metropolis margin positively or negatively in a very significant way. It will dilute margin in this year for the consolidated numbers. From next year, it'll dilute as well, but not as significantly because next year we hope to move to a double-digit profit margin for core.
Right. But Ameera, how are you expecting growth to shape up over the medium term? And which segment or unit you think is going to contribute the largest share of incremental revenue? Is it True Health, Specialty, B2B, or Tier 2 and 3 expansion?
So it's two parts of growth, right? As we've seen this year, if you actually look at our revenue report, it was about 23% for the first half of the year. And of that, about 12% was organic, and the balance is acquisitions that we've done, which we are obviously then creating value for our shareholders by creating margins in it. So in the organic growth, the combination is of volume and moving up the value chain, therefore giving the revenue per patient hike, which is really not coming so much from price, partly from price, but more so from the ability to sell more specialty tests and the ability to bundle more packages and sell them. But we do this very scientifically. We don't do this commercially. And therefore, while we are at about, I think, 19-20% of our revenue comes from these bundled packages, what we call True Health, we believe we can take that to 25% over the next 12 to 18 months. So these two are the levers along with volume that will really drive the organic growth. That will come obviously from geographical expansion. It will also come from deepening the productivity per center. And then whatever balance we do, that will come from the inorganic side of it, which we believe will continue to be a part of our strategy going forward.
Inorganic will be only from a geographic expansion standpoint, from going deeper, or will it be additional capabilities that you bring on board, including tech? How should one think of expansion in the inorganic space?
I think the one that we've done many times before is the geographical expansion, right? Which makes a lot of sense because Metropolis can obviously go anywhere in India on its own. But the kind of business that we build as organized chains when we go into these markets is more around the specialty care. If you want to also buy the local business, which has a local consumer brand, it's important to do an acquisition in that geography that gives you then a base to grow from. And that makes the growth far more accelerated. You're obviously buying these businesses at lower multiples than you're trading at. So you're also creating value for your shareholder through the arbitrage of that multiple and still getting a good ROCE from it in a few years. So overall, it's a beneficial strategy. But the important thing is to buy good quality businesses. And that is the real trick because very few good quality acquisitions are available in India, which are clean, which have integrity, good consumer brand. And we're very picky about who we pick up. But assuming you get a good one, we will continue to do those. We will also look at other kinds of acquisitions, like Core was a more specialty acquisition, which really gave you a different strategic purpose and also happened to be a deal in distress, which we had the ability to then turn around. So we will continue to keep our eyes open for any such strategic options. But the geography one is something we've done many, many times before.
Right. We were just trying to understand as to how much do you grow and from where does the growth come in. But Ameera, I'm very curious to ask you about how is it that you're seeing opportunities in the GLP-1 space, and can the related testing then become a revenue contributor? And this on the back of Novo Nordisk now, launching an oral of dosage now of GLP-1, or at least getting an approval for that.
I mean, GLP-1 is obviously going to be, one more product, sort of testing for it will be one more product that we'll add to our menu. We will obviously see with the Indian generics launching GLP-1s in March, really expand the market for these drugs. And with that, people will have to monitor their hormones and have to monitor their blood sugars and all other kinds of markers in their body on a regular basis, not only to know where they are starting from, but to curate the dosage as they go along. So we do believe that testing will be relevant for them. Is this going to create a completely separate segment that is going to be massive? I'm not so sure. Time will tell, but it will certainly be one more product that we will add to our test menu, which will make people who are high functioning, health, sort of focused people certainly test more. But these will be mostly routine tests, your cardiac markers, your diabetes markers, your liver function, your kidney function, to see if there's any impact of the GLP-1s on any other parts of your body. But overall, it should increase testing.
Right. Ameera, B2B versus B2C. Give us a pulse of what margins typically are, B2B versus B2C. And will the mix change significantly for you? Currently 60-40?
I don't see the mix changing drastically, to be honest. And this mix also changed because core is getting added in. So only if you look from an arithmetic consolidation base, the mix changes. But otherwise, on an organic basis, it is 60-40. And as you know, our B2C has been constantly increasing. The margins between the two really depend on what channels you create. So for example, in B2C, you have your own centers and you have your home visits if you do directly. And then you have your franchise centers, and both of these will have different margins depending on the productivity per center. And then you'll have B2B as well. In B2B, if you just do the common 2, 3, 400 tests, you may land up having better margins. If you do the entire variety of tests, your margins will be slightly lower from a gross margin perspective because the specialized tests don't have as much volume yet. But you have to understand that all of these is not just about the margins they contribute. Because if you don't offer the entire range of specialized tests like we do, in our case, it increases the stickiness of our business. When you're offering something that everybody else does, then it just becomes more commoditized. So in our mind, offering the entire range of tests is a very important differentiation to therefore command better prices, command better gross margin.
Okay. Thank you so much, Ameera, for coming in and speaking with us. This was great in terms of insights. Also,